President Trump this morning waiving the Jones Act for 60 days in a bid to calm oil prices, which are higher again this morning as the war in Iran escalates. Let's bring in Daan Struyven. He is co-head of global commodities research at Goldman Sachs. And Dan, just your initial thought on whether this will loosen things up at all, whether in the product markets or for crude itself?
By relaxing the requirement that ships transporting oil and gas have to be U.S. ships, you could expect some modest relief for fuel prices, especially on the U.S. East Coast. Based on academic studies, you could see some relief in the tune of roughly 10 cents a gallon, with the biggest effects in places like the East Coast that are net importers.
And I guess, Don, if you could kind of do the hierarchy of concerns here as we look at these markets. So, you know, we look at WTI and Brent in terms of spot. We're looking at the forward curve also move a little bit higher, but then a lot of focus on the regional variations, Oman crude shooting higher in price, and then this bottleneck with refined products. So where would you go first in terms of trying to highlight the potential impact in the short term?
Yeah, so the tightness and the upside pressure on prices sort of follows the following ranking. The greatest tightness in Asian refined product markets, especially for heavy products such as jet fuel and fuel oil. Second, a very significant tightness for Middle Eastern crude grades such as Oman and Dubai. And third, significant upside price pressure, but so far more limited tightness in the Western crude markets, such as WTI in Oklahoma and Brent in the North Sea. Ultimately, consumers and businesses pay refined product prices. That's ultimately what matters for the effects on inflation, real income, and GDP growth.
Don, of course, the news today is this attack on the South Pars facility in Iran, and this notion that upstream infrastructure is going to be considered increasingly a legitimate target. How much of a danger is that for price?
Yeah, it's a very important upside risk to prices. I think the top two upside risks to oil prices are, one, a lengthier disruption of Strait of Hormuz flows, and second, the possibility of persistent damage to energy infrastructure, whether it is export facilities or production facilities, once the strait reopens. This is the largest oil supply shock in history. For now, it's still relatively brief. But if I review the 5 largest oil supply shocks in history, on average, 4 years after the start of the shock, production in the affected region is still about 40% lower than before the shock, perhaps because of damage to infrastructure or because of weak investment if insecurity continues. So this is a very important risk to watch. And so we do think that the rise in oil prices we're seeing today, especially for Brent and non-US benchmarks, is appropriate. We think the risk premium had probably been somewhat too modest relative to this very significant upside risk to prices.